Let's talk about 1929. The stock market was soaring. People were getting rich millionaires are broke. Over the next 3 years, the market loses 89% of its value. But the real catastrophe happens next. The banks that lent all that money start to fail. People rush to get their savings, but the money isn't there. It's been lent out. When a bank fails, your money is just gone. By 1933, nearly half of all American banks had failed. Unemployment hit 25%. An entire generation was scarred. It didn't happen because of bad luck. It happened because the system got over-leveraged, overconfident, and totally detached from reality. Now, let's talk about today and why 2026 could be worse. The pattern is identical, but the scale is terrifyingly larger. Back then, people borrowed to buy stocks. Today, we borrow for everything. We have a $35 trillion national debt. Corporations are drowning in debt. We're all maxed out on credit cards, car loans, and mortgage. We've normalized a level of debt that would have horrified our great-grandparents. And it gets worse. In 1929, the debt was mostly an American problem. Today, the entire global financial system is interconnected. A shock in one country hits everywhere else within hours. And just like the 1920s, we've lived through a boom fueled by easy money. For 15 years, central banks printed trillions of dollars and kept interest rates near zero. That money flooded into stocks, real estate, and crypto, creating what many call the everything bubble. But now the party's over. The Fed started raising interest rates to fight inflation. Just like in the late 1920s, tightening the money supply has consequences. Companies that were profitable with 2% interest are now bleeding cash at 7%. Commercial real estate is in a freefall. Regional banks are sitting on massive losses. We already saw the warning shots in 2023 with Silicon Valley Bank and First Republic. Those weren't isolated incidents. They were tremors before the main earthquake. This is where 2026 comes in. Economic cycles don't turn on a dime. They build slowly, then break suddenly. Right now, most people feel okay. The job market is holding up. Stocks seem resilient. But beneath the surface, the cracks are spreading. Corporate bankruptcies are rising. Credit card defaults are climbing. By 2026, I believe these problems will compound into a full-blown crisis. What makes this scarier than 1929 is speed. Back then, panic moved as fast as people could run to their bank. Today, it moves at the speed of the internet. When Silicon Valley Bank failed, depositors pulled $42 billion in a single day, many just by tapping on their phones. When the next crisis hits, you won't have time to react. By the time you check your retirement account, it could be down 20% before you've had your morning coffee. So why isn't everyone preparing? Because we've been conditioned to believe in the bailout. For the last 15 years, every time things got scary, the government stepped in and fixed it. We've developed a normalcy bias, the belief that because something hasn't happened recently, it won't happen at all. It's the same thinking that kept people buying stocks in September 1929. But here's the harsh reality. The tools that saved us before won't work this time. The Fed can't just print trillions more without causing hyperinflation. The government is already drowning in debt. For the first time in decades, when this crisis hits, the safety net might not be there. I believe something is going to break. It doesn't matter what the spark is. Once confidence cracks, it cracks fast. The selling will accelerate. But it won't just be stocks this time. Real estate, crypto, retirement accounts, everything will be hit. People will stop spending, businesses will lay off workers, and the downward spiral will feed itself. In today's connected world, there's nowhere to hide. I look around today and see the same setup as 1929, record high markets, insane levels of debt, and a blind faith that this time is different. The warning signs are here. The question isn't whether the tremors are real. The question is, are you going to do something about it before the ground gives way? This isn't about panic. It's about preparation. Be honest about risk. Reduce your debt. Understand that the next few years might look very different from the last 15. The scariest lesson from 1929 isn't that the market crashed. It's that nobody believed it could happen, even when all the signs were there. Don't make the same mistake.